Hi, my name is Chris Bird, and I'm doing a series of webinars for my good friend Jamie Alden Frey. And my background is this. I'm an ex-IRS agent. I was one of the bad guys, so everybody boo me if you want to, but that was a long time ago. I'm a certified financial planner. I'm enrolled to practice for the IRS, but my main calling is I'm on the road about 100 days a year doing seminars on the topics that I'm including in this webinar series for my friend Jamie Alden. So what I want to talk to you today is about vehicles. Vehicles. I just wrote a paper for Auburn University on the electric vehicle tax credits. A good friend of mine, in fact, our videographer, just bought a Ford Lightning that he uses 75% for business. We'll go ha on that, but anyway, 75% for business. And he got a $7,500 credit from the government, sent from the federal government to his dealer, which reduced his purchase price of 60 grand for that beautiful vehicle to $52,500. Now, using it at 75% for business, he's going to get another $35,000 to $40,000 write-off this year if he wants to. But remember what I talked about earlier about lowering your taxes too much in low years versus high years, things like that. So what I'm saying, everybody, this is a real issue. And this applies to me. This applies to every self-employed person, whether you're in real estate, whether you're in engineering, whether you're in videography. What I'm talking about now applies across the board. So here's the deal. The previous administration greatly helped this deduction, all right? And the current administration has gone along with it as well in Washington. So look at the board if you would, please. Prior to 18, a luxury car was a car, not by listing of what is a luxury car, but simply by cost. The federal tax law said a luxury car before 18 costs more than $16,000, which was a joke, everybody. I mean, you go out and buy a new Yugo when they made them, spend $17,000, and that was regarded as a luxury car. But the reason for that is Congress got tired of people in California, movie producers, buying a $250,000 Rolls Royce and writing the darn thing off over 3 years. So that's why these luxury car rules came about. Well, the previous administration, starting in 2018, look what they did. They raised that $16,000 to $57,320 or whatever it says, all right? Which means that you can get a much larger write-off on your cars or your SUVs than you've ever gotten before. All right, now the third bullet is the heavy SUVs, which I'm going to talk about here. I'm going to show you pictures. The heavy SUV or pickup truck is a vehicle with a gross vehicle weight rating greater than 6,000 pounds. Everybody, I'm parsing my words because I have to be very precise here in telling you this. And that GVWR is on the window sticker on the driver's side door or door jamb, and it either is or it isn't. It either does qualify or does not qualify. So the point is that here are the rules for most vehicles, but the heavy SUV and the heavy pickup trucks are not subject to that $57,320 rule. Now, part of this too is the standard mileage rate, and I'm looking out my car right now. I'm just going to look out the thing, and everyone, I'm reversing my life. All right. So when I was young and dumb, like at Craig's age at 32, all right, my videography, I bought vehicles that I may have not been necessarily able to afford, but I had them anyway. All right. Well, now everybody at my age, and I'm older than Craig, and I can afford, I think, whatever I want. I drive a hamster Kia Soul to run around town because it gets 35 miles to the gallon. All right. So my point, everybody, maybe you get smart when you get older. Who knows? All right. But Craig will claim on his Lightning, all right, he'll claim the actual expenses on that Ford pickup, all right, because he wants the big write-off. Well, on a hamster out here, the Kia Soul that gets 35 miles a gallon, I'll claim the standard mileage rate. And look what those rates are, everybody. They've never been as high. So in 2024, the standard mileage rate is 67 cents per mile. I'll guarantee you this, it doesn't cost me 67 cents a mile to drive that hamster car. So realtors, you have a choice. You have a choice between actual and you have a choice of standard. And talk to your accountant about it. Clearly, the standard mileage rate means less record keeping, no ifs, ands, or buts, all right? But it's not the best for everybody. Now, look at this, all right? So standard mileage rate or actual expenses. So what Craig's going to do, everybody, look at the list. He's going to write off licenses, taxes, car washes, waxes, repairs, insurance, interest on the loan, oil and lube, fuel costs, and look at the word I've underlined, depreciation, depreciation, depreciation. I cannot depreciate my Kia Soul because I'm taking the standard mileage rate. Craig can take depreciation, which is that big deduction also because that vehicle weighs over 6,000 pounds. Now, look at this if you would, this next slide. So this slide applies to a regular car, everyone. If I was going to depreciate, let's say I went out and bought a $55,000 Lexus Infiniti, whatever, car, not a heavy SUV, all right? And I was going to depreciate it. The limit is $57,320. And remember, that's taken over 5 years. And this is actually the chart on how you write off that $57,320 over 5 years. Now, if you use it 90% for business or 80%, then every one of these numbers is multiplied by 90 or 80%. But this is for regular cars or light SUVs. Now, what I want to get into, Craig, and listen up on this, here comes the heavy SUV, everybody. Here comes the heavy SUV. And this happens to be a Lexus. Look at the L. And I think this one is the one that qualifies. And there's over 150 vehicles. Just type into internet, so you know it must be true, list of heavy vehicles qualifying for the big write-off. You'll find a list. Now, here's what you look for. This is called the production plate, and this is on the driver's side door or door jamb. Look at the upper right-hand corner where you see the word or the reference to GVWR, gross vehicle weight rating. In imperial pounds, everybody's got to be over 6,000. This qualifies. If this says 6 or less, it does not qualify. Simple as that, all right? Now, what do you qualify for? Watch, all right? Now, do not tie me with what that picture is, the year and all this good stuff, but assume whatever this is, it's the heavy SUV, all right? And assume with me, and this is your Lightning, all right, right on the nose, and you got 60 grand cost. If you use that 100% for business, you'd get to real close to 60,000 bucks. Not quite there, but close to it. All right, and then the same is true for the heavy pickup truck. All right, 60 grand. Craig's going to get the added benefit of a $7,500 credit, which he's already got. He paid $52,500 for this. He would have paid $60,000, and then he's going to get to write off most of the $52,500. So I leave you with this, realtors. All right, I personally believe, and this is what I tell my clients: your car does not make you, your vehicle does not make you a better realtor. All right. Drive what you can afford to drive. I already told you my point. I can much afford 4 times that car, but I still drive that little wonderful Kia Soul. All right? So don't buy above your means for a tax write-off. All right? If you're making the money to afford one of these things, then go for it if that's what you want to do. Then talk to your accountant about writing it off. But do not ever let the tax write-off be the motivating factor for doing anything. We call that in the business letting the tax tail wag the dog. All right? Thanks. See you in the next webinar.